Alright, so I'm looking at the gold chart for the past 3 years, and I'm looking at the top in 2011, 1920, and I'm looking at close to right now. As of yesterday, gold was around 1238, somewhere around there. Anyways, what I wanted to show you with this graph first is to show you, number one, that this market did not go down in a straight line. There are a lot of people saying that, hey, the market's going to crash, stock market's going to crash. I initially thought it was going to crash. However, I believe that there's going to be a slow move to the downside, just like we saw in the price of gold. And we saw this triple bottom here the other day. But anyway, we shall see whether, first of all, that triple bottom holds intact. Anyways, look at the top of like around 1920, close to 3 years ago. And we saw that it hit close to 1783 times, okay? One time in 2011, one time in 2012, early 2012, like February-ish. And then we saw another time in October of 2012. So close to 2 years ago. So if you want to look at that, so for approximately 1 year, the market went down close to 7%. I could show you the math. So 1920 minus 1780. Alright. So 7.3% moved to the downside, and it took 1 year. Because a lot of people are still thinking that, hey, the dollar is going to collapse this year, right? A lot of people were in that camp, including myself. So what ended up happening the year after is central banking on steroids with the yen carry trade, right? You had Abenomics, right? So in terms of yen, it was much better to hold gold than it was in terms of dollars, because as the yen continued to weaken, the gold price went down. And it also maybe had to deal with central bankers and the amount of gold that they purchased on the open market. There's a good video by Moments in Trading about that. But anyways, put that aside for now. And let's look at the stock market, where I want to show where my thoughts are, right? I'm not going to guarantee any price targets, this or that. That's you to decide on how you want to handle your portfolio, right? But I just wanted to show you what I see as similarity in the stock market as a whole. Alright, so I'm looking at this yen carry trade right now, which I was telling you about since this year. And you could see the Dow over here and the dollar yen over here. The dollar yen is in the blue, the red represents the Dow. And what I've noticed for the past close to 2 years is that this yen carry trade is most of the time going in tandem with the Dow. And my theory behind this is that it's pumping in liquidity into the US stock market, which I've mentioned the science behind that. But anyways, so we saw last week that the market started to go down, and what really no one was talking about in the mainstream media, alternative media, I did hear some traders though, sophisticated traders, or some people involved in the game, and they correctly understood that, hey, the dollar yen was appreciating, right? Risk off. Long story short, that's what I got from these traders who knew what they were talking about. And there were some traders that had other ways of determining that the market would go down as well. So I want to also mention that. But anyways, you could see that they're going in tandem. And I was listening to Keith McCullough, that libertarian guy who has a research site, or he has just a staff of research individuals. And anyways, he was saying that he thinks that the dollar yen is getting close to a short-term top again. Around, he looks at it from a trading perspective though, so I don't know what's going on in his mind on a day-to-day basis, but this is what I heard him say yesterday. He said like maybe around 107 point maybe 33, or I forgot his target, or 107.48, around that range. So we're kind of close to that. And what I was looking at in my head, or what I was thinking, is I don't want to put on any more shorts, or I don't want to add a short position until maybe 16.5, 16.6. That's what I'm looking at right now. And I wouldn't want to short at sometime in November and late November and most of December, because obviously the Christmas season. Just wanted to get that through. But anyways, over here, this yen carry trade, right? As I showed you in the other video, it has been weakening against the dollar close to 44% over 3 years. And my theory is that markets don't go up in a straight line. There's going to be time for consolidation or room to the downside. And I feel that this dollar yen has pumped in too much liquidity into the market, and it's going to take a breather. Who knows? Maybe for the next few years, maybe a year. Don't know. But anyways, long story short, if there is liquidity coming out of this yen carry trade, meaning that the yen is appreciating and going down, as you can see, like to 106 the other day, I feel that the markets are going to go down, and this could be one of the catalysts for making the overall markets go down for the next few years, or one of the reasons. But people are saying that, hey, it was Ebola that made the markets go down, this and that. Well, there's more to that in my opinion. I felt that the other piece of the puzzle has to deal with margin debt, and I'll show you right now. So what a lot of people don't look at is margin debt, right? It's really simple, but it's something that is ignored by many individuals who are in the marketplace. And also, what I've noticed is that you seem to have euphoria as you continue to have excess margin in the system. And then when this excess margin, how should I say it, goes down, then as a result the markets go down. So margin over here in blue, red represents the market. And this is the S&P, by the way. So if you look at this since 2009, and I've showed you this in other videos, it's been going up, up and up, right? No major correction in the amount of margin in the system, right? There were some times where people took margin off the table, took liquidity off the table, correction, right? But anyways, it's been going up in a straight line for the past 5 years. And people are saying that, hey, it was Ebola, this and that. What was going on is you have excess margin in the system. And because of this excess margin, what happened with the yen carry trade over here, right? What happened was they took some risk off, right? Yen appreciated, and then going back to the margin, right? This most likely came down. We won't know the exact figures until maybe a few months from now, but this is only up until August, it looks like, of this year, July or August. And this is going back since February of 1960. So I have approximately 45 years of data over here. And things didn't really get out of control until you had this yen carry trade, right, coming on steroids. That added the extra juice to the system, right? Just like in the 90s when you saw all these baseball hitters hitting home runs, yes, they were strong, but they had an extra stimulus. The extra stimulus is coming from this yen carry trade, which is making markets go higher than where they should be going. And this is just totally screwing up the price discovery mechanism, in my opinion. So what does this have to deal with what I was talking about earlier on with the gold price, right? Well, my thesis, like I said before, is that the markets will not go down in a straight line. I mean, they went down pretty much in a straight line, you could say, from 2000, 2001, but then it took a few years for the bull market to come back. But if you want to look at a better example of what I was trying to say, the markets went down in a straight line in 2008 to 2009, right? It was still around like 11,500-ish, or 13,000 some hundred in May of 2007 or 2008. And then all of a sudden, it went down all the way in 1 year to down 6,600-ish, right? Over here. Or this is the S&P. So S&P hit close to 700-ish, or maybe a little less than that. But then all of a sudden, we've seen it go up in a straight line, and there are a lot of reasons why it went back up. Well, this time around, we have central bankers on steroids, and Janet Yellen, she's a dove. All the individuals in these Federal Reserve offices in Chicago, New York, Minnesota, they're doves. So if they're all doves, that means that, in my opinion, the market will not go down in a straight line. You usually see every 8 years the business cycle turning around, right? According to government data, which I believe is rigged. Anyways, 2000, 2008, 2016. If you want to go back to 92, there's another time where you had an economic slowdown and a change of guard for the presidency. So what I do see happening in the next few years, I see the markets going down, presidential change, and then also I believe we're in a secular bear market, which I mentioned also in previous videos. So like I see with gold, what I do see happening with the overall markets in general, I just see it going down, but it's not going to go down, in my opinion, in a straight line. And it just totally reminds me of what happened in 2011 with gold, right? It took more than 1 year for it to go down 7.3%. And that we may probably still have that, because probably people are still going to be bullish, and then we're going to have a catalyst that makes the market go down significantly more, in my opinion, in 2016, the year of the election. People are going to be caught off guard. And maybe one more year of consolidation around 11,700. And then I feel that for the next few years after that, until 2020, we're going to be having some sort of short-term bull market. But then, I don't know, it seems like it's going to go down again. But we shall see how it happens, right? This is just my thoughts, guys, or these are just my thoughts. Remember just to do your due diligence before investing, and I'll talk to you later, guys. Bye.